Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. I was out in Las Vegas this week presenting at a conference hosted by Barlow Research. It does great work into how well the needs of small to mid-sized businesses are met by commercial banks. Anecdotally, I have to tell you there is little evidence of economic or risk appetite slowdown. The planes were packed, the hotel was packed, the casino was packed, and there was plenty of evidence of inflation, right down to those $10 bottles of private label, not even the good stuff, water. Life is good for many, I suppose. All right, this week our three things are: 1. Corporate earnings growth. It's holding up better than some have forecast. Here's why. 2. Consumer spending. The latest data suggests that changes are afoot. And 3. S&P walks back its proposed changes to its insurance methodology. Here's why you, a broad-based credit investor, should care. All right, let's dig a bit deeper. Corporate earnings growth. We are approaching the end of Q1 earnings. There was a high degree of focus this go-around, of course, with the banks disclosing the effects of forces that led to 3 mid-sized bank failures. Away from the banks, investors continue to look for updated color about what the future looks like, the effects of tightening financial conditions and inflation on margins and growth. We also pay close attention to corporate earnings growth because every asset class and credit is dependent to varying degrees on the health of the corporate sector. Now, even though the quarter's performance, which is down 3.7% for the S&P 500 thus far, is likely to result in an earnings recession, i.e. 2 consecutive quarters of earnings contraction, on just about all accounts, earnings have come in better than expected. According to FactSet, both the number of companies reporting positive EPS surprises and the magnitude of those earnings surprises are above their 10-year averages. Of the 457 companies in the S&P 500 that have reported thus far, 256 or 56% grew earnings year over year, and 78% have beaten their estimates. The top line has grown 4.2% for the group, and some 68% have beaten revenue estimates. More than not, 54%, have beaten their estimates on operating margins. That's the most since the first quarter of 2022. Operating margins are showing signs of stabilizing after falling for the past 3 quarters. And the current level, 14.5%, still compares favorably to the 5-year average prior to the pandemic of 14.2%. Performance among bellwethers suggests that the companies have prepared for and are adjusting well to the economic downturn. Of the 30 stocks in the Dow Jones Industrial Average, half have outperformed the broader market on the first trading day after their release, including consumer stalwarts Procter & Gamble, Walgreens Boots, and Walmart. All of this, of course, by its very nature, is backward-looking. So what's noteworthy about future guidance? For Q2, 44 companies have issued negative earnings guidance, while 35 have issued positive guidance. Travel and leisure names dominate the upward revisions, explains what I saw in Las Vegas, while industrials are driving the downward changes. Now, taking a step back, we think about the following themes as driving earnings. 1, the extremely well-telegraphed nature of the downturn has enabled managements to adjust everything from marketing spend to CapEx gradually and proactively. That helps. 2, the problem, inflation, and the solution, tamping down demand, are well known at this point. That's expected to result in a mild and manageable downturn. And that visibility, in turn, allows managements to maintain much of their own strategic initiatives, which is, for the most part, keeping earnings on track. And 3, consumers in the aggregate have kept up their spending, making this landing relatively soft thus far. On that note, we move on to our second thing, consumer spending. 3 things have propelled the economy over the past year at a speed that most prognosticators would have to admit has been stronger than expected: consumer excess savings, consumer borrowing, and the still tight job market. All 3, however, are changing. The Federal Reserve Bank of San Francisco is out with a report this week that estimates that excess savings, essentially additional savings resulting from stimulus and lower expenses during the pandemic period, is down to a mere $500 billion. Our own estimate is closer to $700 billion. Inflation notwithstanding, $500 billion is still a pile of money, but it is down from what the bank estimates was $2.1 trillion at its peak in August 2021. That excess cash has fueled inflation by keeping consumer demand and spending relatively strong through the correction. Meanwhile, consumer borrowing has been growing at an above-average rate over the past year or so, as individuals augment existing cash flow in order to maintain a spending lifestyle that naturally elevated during the pandemic as household net worth surged. But the latest senior loan officer survey conducted by the Fed shows that the banks have tightened loan underwriting standards across all consumer loan categories except credit cards. And in the most recent University of Michigan survey of consumers, respondents said that current conditions for buying large household goods is far worse today than it was during the GFC, which, of course, was caused in large part by excessive consumer borrowing. And now, in a related move, we are beginning to see evidence that the labor market is cracking, something that the Federal Reserve has set as a goal of its tightening of financial conditions. Jobless claims are rising, wage growth is slowing, and businesses are dialing back their hiring plans, according to surveys. So if we add it all up, the consumer, the force that drives 2/3 of the economy, is feeling less flush as savings fall, less confident as layoff announcements proliferate, and is seeing his or her ability to maintain pandemic-era spending constrict. It is important to note that all three factors are changing gradually as opposed to a shock, which can have a more profound impact. In other words, it suggests a softer landing, but a landing nonetheless. All right, on to our third thing, insurance company demand for credit. I don't think I'm telling you something you don't already know, but insurance companies are big buyers of credit. Secured, unsecured, public, private, U.S., non-U.S. So it was noteworthy to see S&P put out for comment a year ago proposed changes to its insurance methodology, the roadmap for how it rates the creditworthiness of insurance companies, and specifically as it relates to its risk-based capital adequacy methodology and assumptions. The significance of their proposed changes to the broader market was less about how ratings might change on their rated universe of insurance companies. No, the broader issue, the thing that is meaningful to the broader market for credit, is how their proposed changes could alter demand for credit by insurance companies. S&P was proposing to haircut securities held by insurance companies that were not rated by S&P to as low as CCC, regardless of where other NRSROs, that's nationally recognized statistical rating organizations to the uninitiated, rated that obligation. Safe to say, market participants cried foul. This would distort and redirect demand to securities simply by virtue of whether or not S&P rated that security. This week, S&P walked it back. On May 9th, it re-released its request for comment on the insurer risk-based capital adequacy methodology and assumptions. This time, its proposal provides for the use of other rating agency ratings, provided that the ratings from an NRSRO are registered and certified in accordance with rating agency regulations, included in a mapping table that is used by insurance regulators in establishing capital requirements for credit assets, included in a mapping table produced by the regulator that relates the rating agency's rating scale to S&P's global rating scale, and included in a mapping table that is publicly available. Have a look at the new proposal. Comments are due June 30th. So there you have it. 3 things in credit. 1, earnings reports. They've come in better than expected, which points to the well-telegraphed nature of this downturn and the ability of company managements to prepare. 2, the consumer spending party is winding down. It's predictable. After all, that's what the Fed has been trying to do. But it's not falling off a cliff, and that's good for credit markets. And 3, S&P's proposed changes to its insurance methodology have been walked back, and that will help demand for the broadest range of credit. As always, thanks for joining us. Don't forget to check in on kbra.com for our ratings reports and our latest research, including a piece I wrote last week on the future of regional banking. See you next week. Hello, listeners. Join me, Van Hesser, KBRA's chief strategist, for in-depth conversations with credit experts in my new monthly podcast, Leading Voices in Credit, where I'll interview market professionals on the latest trends in credit markets. That's Leading Voices in Credit with Van Hesser. Subscribe now.